lot of us have the notion that when somebody says they're an accountant, they are a CPA. Can you break that down?
Yeah, no, that's one of the big misconceptions out there about accountants. Everyone thinks that all accountants are the same, or all tax preparers are the same. But, as Meek Mill says, there's levels to this, right? And I don't mean that in a rude or condescending way, but basically, as it relates to the accounting profession, you have all these different types of professionals. You got tax preparers, you got bookkeepers, you got enrolled agents, you got CPAs, you got tax attorneys, you got all these different types of individuals, right? So as far as accountants go, so you have, let's just start off with one of the level one, right? So you have tax preparers and you have bookkeepers. In order to be a tax preparer, you don't necessarily need to go to school having a background in accounting. Like even if you look at like the H&R Block website, they have a lot of tax preparers. One of the requirements in order to work at H&R Block is that you just need to be 18 years and older. You don't need a GED. You don't need a high school degree. You just need to be able to take their income tax course. If they like you, then you'll be able to work with them. And these individuals do your taxes for you, right? But again, you don't have to go to school. So if you wanted to tomorrow tell people like, yo, I'm doing your taxes, you can do that, right? So that's tax preparers. Then you have bookkeepers. Bookkeepers are people who could do your accounting for you, usually in QuickBooks. They organize your transactions for you. Again, you don't need a degree in order to do that. And then you have accountants. Typically, when someone says they're an accountant, that means they have an undergraduate degree in accounting. So they went to school probably for 4 years and basically went to school for accounting.
Understood.
Then you have another level above that as it relates in the tax world. You have what are called enrolled agents. So enrolled agents are individuals who took a 3-part exam with the IRS in order to understand the tax code. And with enrolled agents, they know a lot about taxes. But with enrolled agents, you don't necessarily need to go to school to be an enrolled agent. That's the enrolled agents. And then another level above that is certified public accountants, CPAs. Now, in order to be a CPA, you typically need to have 150 credit hours. 150 credit hours usually comes out to like having a bachelor's, having a master's.
Right.
The undergraduate degree has to be in accounting. Then you have to work under a CPA for a year. And they have to sign off and say like you did good work. And then you have to even before that, you also have to pass a 4-part exam with to be able to pass the CPA exam, and that has less than a 50% passing rate. And the interesting thing with CPAs is only less than 2% of the CPAs in the country are black. So like the fact that if you come across a black CPA, it's very rare because the majority of CPAs are of other races. But there's definitely different tiers, different levels to it. But the CPA is the highest of the highest as far as like education, background, the requirements in order to meet that.
Man, you teaching me. It sounds like you just told me how to become a doctor.
And the interesting thing, what I also share is this too. Even as a CPA, that's still not enough for a lot of business owners and investors, and this is going to be extremely key too. So a lot of times people hire CPAs and they think, yo, I'm good because that's a CPA. You went to school, you have the highest degree, It's still not enough because the thing about it is, from my experience, when I went to school, looking at the CPA exam, it's really geared towards having you work in corporate America, right? So they're not really teaching you all the different nuances about taxes as it relates to business, small businesses, right? It's more related to on the corporate side. Same thing with investors. They don't really get too deep into like real estate investing, stocks, etc., right? So there's another level, right, that I call the tax elite, right?
Okay.
So this is not something you could look up in Google, but tax elites are the individuals that you need to be considering in order to work with as it relates to working with you as far as taxes are concerned or just accounting in general, right? So the first part of that elite is education. So did this individual go to school for accounting? Did they go to school for tax? If they did, that's a plus sign. You could check that off. And elite is an acronym, by the way, so I'm breaking down ELITE.
Understood.
The next part of that is L, legal representation. So can they represent you in front of the IRS? So enrolled agents could represent you in front of the IRS. CPAs have the authority to represent you in front of the IRS. I didn't know that. Yep. Accountants, people who just go to school for accounting, just have the bachelor's degree, they can't do that. They don't have the authority to do that because it's just a certain level of expectation that the IRS has in order for you to represent people. The next part of that is integrity. So integrity really relates to, are they doing things legally and ethically? You know, are they telling you to do things that you shouldn't be doing, telling you to claim kids you don't have, all this other kind of stuff, right? So you want to make sure you rock with someone who's doing things with integrity. Then the T comes with training. So training is basically, are they constantly being trained? Are they required to be trained? Are they keeping up with the latest and greatest tax information, right? There's about to be a whole bunch of changes as it relates to the tax code with Joe Biden. He's looking to make some significant changes next year. Are they keeping up to that? So that's one of the requirements as far as CPAs and enrolled agents. We have basically what are called continuing education credits in order to maintain that license. Right. Accountants, if you went to school for accounting, there's no requirement to
Gotcha. You're
to
pretty
maintain.
much done there.
Yeah, you're pretty much done. You get the degree, boom, you're good. And then the last part of that is experience. So how much experience does that individual have? So how long have they been in the industry, right? So I've been in the industry for over 10 years now. And then also, too, you want to also understand the industry experience as well, right? So do they have experience working with real estate investors? Do they have experience working with your particular type of industry? Because there's different nuances, right? The tax code, there's over 74,000 pages in the tax code. So working with the individual who has a lot of experience or is maybe focused on that niche is going to be most beneficial for you. But yeah, that's the tax elite. But yeah,
there's just so many different things. So what type of services should we acquire as investors? You know, let's just say we're doing fix and flips. What should I go to my accountant and say that I need from him?
Right. So that's going to be key. So really, as it relates to that, and this is another thing that the tax elite do, is they do a service called tax planning. All right, so tax planning is looking at your life, looking at your business, looking at the regulatory requirements, and identifying and showing you ways for you to legally and ethically, proactively save money on taxes, right? Because there's a concept called tax avoidance and there's tax evasion. Tax avoidance is legal. Basically, tax avoidance is looking at the tax code and finding ways that you don't have to pay more money than you need to on taxes. Okay. Tax evasion is when you're pretty much lying, right? So you're pretty much you capping, right? So you're saying like, yo, I'm making less money than I actually am, or I'm spending more money than I actually am. So one of the things that you want to look at as an investor is, are you working with an individual, right? One, making sure that you work with that tax elite that I mentioned, right? Mm-hmm. That meet those qualifications. That's going to give you a better chance of having a positive experience working with that individual. So tax elite, and then you also want to make sure they're doing tax planning as well, right? So showing you how to proactively save money on taxes. Are they telling you about the 1031 exchanges? Are they telling you that Joe Biden's looking to probably reduce some of that benefit? Are they telling you about cost segregation and a whole bunch of other benefits as far as being depreciation? How can you accelerate some of that depreciation as an investor? So those kind of things. The 1031 exchange is essentially a section in the IRS tax code that allows you to be able to defer your taxes as it relates to property, right? So basically, let's say you purchase a property for $100,000. You go ahead and sell that property for $300,000. Right, the difference between that $300,000 and that $100,000 is a $200,000 difference. Right, that $200,000 is going to be taxed at a capital gain, right? If you hold on to it for more than a year. So one of the things that you could do with that 1031 exchange is you could actually defer some of that gain by reinvesting those proceeds into an equal or greater value type property, pretty much like a like or similar type of property, right? So there's timing things that you need to consider. You also need to work with an intermediary. So basically, it's something that you got to do beforehand. You got to pre-plan it. You consult with the intermediary. You tell them you go ahead, and when you go ahead and sell on the property, they hold on to the money. You identify the property. They go ahead and put that money into that property, and then you're able to go ahead and defer. And you can pretty much do it until forever, right? But one of the things that's coming up now with Joe Biden's looking to reduce some of that benefit. So basically, he's saying that, with the 1031 exchange, I think he's looking to reduce some of that benefit over $500,000. So if that gains over $500,000, then you pretty much have to pay taxes on it. So as it relates to real estate, there's two main categories of real estate, right? So you have residential property and you have commercial property. With residential property, You have to depreciate, and basically depreciation is you writing off an asset over whatever time period the IRS allows you to do. With residential property, basically property that you're using for tenants, et cetera, whatever the case is, you could write that off over 27.5 years. Commercial property is a little bit different. Now with commercial property, you have to write that off over 39 years, right? So one of the things that you could do or look into as an investor is there's a section in the IRS tax code called cost segregation. So one of the things that you could do is you can hire, if the property costs more than $500,000, you could hire like an engineering company, or there's different companies that specialize in this, but they identify different asset classes within the unit, right? So they're looking at kitchen fixtures, they're looking at the carpet, they're looking at different components of it, and then they're identifying different asset classes and different depreciation schedules for those, and that allows you to be able to take advantage of even more write-offs to that year. So you get an even bigger depreciation. So, to basically, the way it breaks down math-wise is that instead of having let's say they identify a carpet and they say you can write it off over 7 years. Mm-hmm. If we're using that 27.5, you're really, without that, you're really writing off that carpet over, and let's say the carpet is $1,000 or whatever the case mm-hmm. is. If you're using that 27.5, you're only able to claim 1,000 divided by 27.5 for the year. But now that you're calling it and saying that you can write off over 7 years, you could do that a lot more quickly.
How should I set my companies up? Should I have it to where they're all under one umbrella, meaning St. Castro Investment Group? Or should I have St. Castro Investment Rentals, St. Castro Investment Flips, and St. Castro Investment Airbnb? What's the best way for me to do that?
Yeah, so it's going to depend on a lot of factors, but I'll give you some general guidance. And that's a very important question. I think a topic that's not talked about or explained enough. So basically, as it relates to taxes, the IRS breaks income down into different categories, right? The two main categories with this topic I'm going to focus on is active income and passive income, all right? Two different ways that you're taxing those, two different tax forms that you're using, completely separate. So as it relates to active income, in the real estate world, you're going to have fix and flips. Fix and flips meaning that you're selling the property in less than a year usually. Wholesaling, right, which is something that you're usually doing kind of quick, less than a year mm-hmm. type of situation. Rehabs, similar to fix and flips, right? Mm-hmm. That's going to be considered active income. When you are dealing with active income, then you can go ahead, and this is pretty much across the board with a lot of businesses, you can go ahead and create an LLC, right? A limited liability company. Limited liability company, one of the benefits of it is that it gives you legal protection in the event that you get sued, right? So let's say you have a tenant, they get upset with you, whatever, they try to come sue you. They can only come and liquidate the money that's within that account, right, if they happen to win that case. They can't come after your personal assets being your bank account, your car, your house, those kind of things, right? So you want to make sure that you either put that type of business into an LLC, right? You'll also have the option to do a corporation, but generally speaking, for most people, LLC is going to be the easiest thing for you to do. Then, because it's active income, you can also, and one of the benefits of the LLC is you can actually make an election. What's called you can elect to be taxed as a S corporation or a C corporation. The default setting for an LLC, if you're an individual, is going to be a sole proprietorship. So now you have the ability to be able to make what's called an S corp election or a C corp election. With the S corp election, one of the benefits of it is that you're able to save on self-employment tax, right? So one of the things that happens with LLC sole proprietorships is that you have to pay self-employment tax, which is 15.3%. Okay. 15.3% is FICA. So FICA is basically Social Security and Medicare, right? So, like let's say you're working a 9 to 5. Usually what happens is you as the employee pay 7.65%. The employer pays 7.65%. As an individual or as someone who owns a business, you're essentially the employee and the employer. So they're making you pay 15.3% on the profit of the business, right? Mm-hmm. So one of the benefits of switching over to an S corporation is that you're able to save on that self-employment tax, but one of the requirements is that you need to pay yourself what's called a reasonable compensation or a salary. So with that, instead of having the 15.3 hit the profit of the business, it's now hitting the salary of the business. So let's say, your business makes $75,000 in profit. Instead of having to pay 15.3 on that, which comes out to about like 13,000, whatever the case is, you go ahead and make the S corp election, 75,000, same income, but then let's say you pay yourself 37,500, now you're paying about $6,000 in taxes, right? So, or $5,000, $6,000, whatever the math comes out to. So that's the $6,000 savings right there, and the numbers get bigger as you make more. So generally speaking, I tend to let my clients know it's good to consider making that S corp election if you're making more than $50,000 in profit. If you're making less than that, it's not going to help you much. You know what I mean? You might end up paying more because there's more requirements. You got to have a more expensive tax return, bookkeeping, etc. Right? That is on the fix and flips, rehabs, wholesaling side of the real estate world. Then you have the passive side, right, which is what you're into, right? Long term, buy and holds, etc. That is passive income in the IRS's eyes. With that, you can just put that into an LLC, and you don't have to necessarily make any tax classifications or whatever the case is, right? Because generally with those, that's going to be on that Schedule E, all right? So that you're not paying self-employment tax on passive income because it's just passive. It's not you're not working for that income. So that's how you need to consider it as far as real estate. And then as far as how many LLCs you want to have or whatever the case is, sometimes people say that it makes sense to have an LLC for each property, maybe just one LLC for multiple properties. Generally, what I do, and it's really on a case-by-case basis, because one of the things is if you have multiple LLCs, you're going to have multiple tax returns or tax forms,
it's
right?
a headache.
Yeah. So there's some states that allow you to do what's called a series LLC, where you have basically one LLC and have a whole bunch of properties in there. That's a whole nother topic for another day. But if you want to consider having multiple LLCs, you just need to look at your risk, right? Because if you have, let's say you have, depending, you want to look at how much money you have in that business. So maybe it may make sense to separate it if you're doing like maybe having an LLC for your residential properties and then another LLC for your commercial properties. Or you could do it to where maybe you have a separate LLC for the different states that you have the properties in, right? So there's different ways to do it. Generally speaking, that's more of a conversation that you want to have with like a tax attorney or a lawyer, because that's more of like, when we talk about LLCs and corporations and stuff like that, those are what's considered legal entities. From a tax perspective, it's not going to make any difference. Actually having an LLC, multiple LLCs, whether you have one LLC, multiple LLCs, it's not going to make a difference tax-wise.
Got you.
So that's because you have what are called tax entities.
Young investor coming in the game, what services do they need from a CPA?
Yep, perfect. So tax planning, that's number one. Number two, bookkeeping too. So bookkeeping is going to be key. You could do that with the CPA. You could just hire a bookkeeper as well. Bookkeeping is not a very difficult task to do. So you don't necessarily need to work with CPA. But a lot of times CPAs, either they'll do it themselves or they have people within their team that can do the bookkeeping. But you want to do bookkeeping. Bookkeeping is going to be important. Basically what bookkeeping is just recording your transactions, organizing it into different categories. So with bookkeeping, one, is going to keep you accountable, because when you're understanding, how your properties are cash flowing, what's going on with it, what expenses do you have, right? It's going to help you maintain and track your expenses. So one of the things with taxes is that you want to document your expenses. So that's what bookkeeping helps you do. And then also too, when it comes tax time, you're going to have your financial statements in place, your income statements, your balance sheet, etc. for tax purposes when you need to go ahead and file your taxes.
What is okay to write off and what's not? You know what I mean? I feel like people play with that, and you know what I mean? Like, you got to do it within reason, right?
For sure. I mean? Yeah.
What are some things that people take advantage of that they should not be writing off that could get them in trouble?
Yeah, 100%. So even taking a step back and making sure we get the foundation on it too. So basically what a tax write-off is, when people say tax write-offs, basically it's equivalent to like a tax deduction. So what happens is when it comes to tax time, you make money, right? So you're making money during the year, and then you have what are called deductions, tax write-offs, and these expenses could actually reduce how much money you pay in taxes, right? So let's say you make $100,000, you spend $70,000 on the business, then you have a $30,000 profit. $30,000 is, just to keep it super simple, that's what they're looking at in order to tax you. So they're saying, okay, you basically you made $30,000 in a year after all the expenses, and then if your tax rate is 30%, then you pay $9,000 in taxes. That's that piece. As it relates to being a business owner, entrepreneur, the IRS actually has requirements in order for you to be able to write things off, right? So there's 4 requirements that the IRS is looking at generally, and then there's a whole bunch of other rules associated with it. But the 4 main requirements, and it's another acronym that I love using acronyms. So another acronym for it is what I call tax-free deductions, right? So free is the acronym. The first part of that, free, is going to be that F, right? So the expense or deduction needs to be for your trade, business, or profession, all right? So basically you want to look at your business and see if the expense makes sense for that business, right? So I know you're in real estate, right? Mm-hmm. But there, in the past, right, you were in the beauty industry as well, right?
Yes.
So with that, it doesn't make sense for you to be able to write things. It doesn't make sense for you to write off hair products in the real estate business, right?
Right.
Because it needs to be for that trade business or profession, right? So that's one thing, and that's why it's important for people to separate their LLCs depending on, or separate their businesses depending on the business type, have their own accounting records, etc., whatever the case is, because it needs to make sense for that business. So it needs to be for your trade, business, or profession. The second part of that is R. So it needs to be considered regular for your business. The IRS calls that ordinary. So going back to that example that I shared with you, the expense needs to be ordinary for that business. For real estate, advertising, commissions, cleaning, management fees, etc. Those things are considered regular for that business, ordinary expenses. The third part of that is E, essential. All right, so essential, the IRS calls that necessary. So what's going to be essential for you to operate that business, right? So in order for you to operate that business, you do have to pay property taxes, you do have to pay utilities, you have to pay other things that are essential for you to operate that business. And then last but not least, and this is the key part, kind of what you're alluding to, is economical, right? So economical, the IRS calls that not lavish or extravagant under the circumstances, meaning that you want to look at how much money you're making in that business, right? So if you're making, $1,000, and I love to talk about writing off the G-Wagon. If you're making $1,000, can't write off the G-Wagon, right? So it needs to make sense. You have to be making substantially more than that expense amount for you to do it. But if you're a multimillionaire like 50 Cent, he did an interview with Lil Wayne on Young Money Radio. He was like, yo, last year it came towards the end of the year. I had this big tax bill. I needed to get it down. So what did I do? He bought 5 cars, right? 50 Cent could do that because he's a rapper, entrepreneur, producer. He's multi-millionaire, so he could afford to do 5 cars, and it's not considered lavish or extravagant for him.
Got you.
You know what I'm saying? So you got to look at how much money you're making in your business. That's one of the factors they're looking at, right? Same thing with travel and all these other things that you're doing with the business. It just can't be. You can't overdo it. There's a saying in the tax world that says, pigs get fat and hogs get slaughtered. Right? So you could be a pig. Make sure you know what I'm saying, you can get fat off some of these deductions. You start writing things off, you know what I'm saying? You don't need to be stingy with it, you know what I mean? So like it's there for you to be able to write off, because the IRS wants to incentivize you to be a business owner, right? Because they believe that business owners, they provide jobs, they provide opportunities, they create commerce, people are spending money, so they want to incentivize you, but you don't want to be a hog to where you're just like, yo, because I have a business, I'm gonna just run it up, right? I'm gonna start popping bottles. I'm gonna take first class everything. I'm gonna go crazy with it. You know what I mean? So you just want to kind of use some judgment, be reasonable. It's always good to have a conversation with your CPA or someone that you're working with to sometimes run things by, or whatever the case is. But yeah, those are the 4 requirements. But so that's what we're looking at. So as it relates to real estate, like I said, some expenses that you can consider, some write-offs, is the advertising, right? So if you're advertising and promoting, it's like, hey, I got this unit available. Hey, I'm trying to sell this. Whatever the case is, those expenses, whether you're doing it on Instagram, Facebook, Google Ads, whatever the case is. Then you also have meals. I talked about meals, right? So one of the things with meals is that you could do is, let's say you're having a meal with a prospective, a possible client or someone that you're looking to do business with. You guys are discussing business as it relates to your real estate. Then that could be an opportunity for you to be able to potentially write off. One of the things that they did this year it used to be 50% deductible. Now they increased it to 100%. As they increased it to 100%
I'm about to go
deduction.
eat.
Exactly, and
How can I prepare to justify the $20,000? Because I'm not trying to like do anything unethical, but I feel like there's a great line there, right? You know what I mean?
For sure.
And I think that I could have went to Roof Chris by myself,
right.
but in essence, people write those off. So how do you justify that to make sure that you don't get hit with any fines or any slap in the hands?
Yeah, it's going back to that economical piece. So you want to make sure that you are, spending money economically, right? So do you really, not say you can't go to Roof Chris, right? But they're going to look at it and say, hey, look, how much money is this business making? Are you making Roof Chris money? You know what I'm saying? So like, again, if you're making only $30,000 in your business and you hitting a Roof Chris on the reg, like, you know what I'm saying, that's going to look crazy, right? But if you maybe do it once a year, maybe a few times, they're not going to go crazy. But one of the things is, on top of that, when it comes to any of these expenses, documentation is key. So going back to the meals specifically, so some of the things that you need to be recording as it relates to the meals is you want to record the restaurant that you're going to. You want to document who you're eating the meal with, because that's one of the requirements. So you need to document the attendees. You want to document what you discussed. So you actually need to show, okay, hey, we discussed talking about this real estate deal here. We want to buy this building. We want to do this, da-da-da-da-da. You want to have that documented, some real quick notes on that. You also want to document how much it costs. And then also, make sure you include the tips and everything, because that's included as well. So those are some things that you need to make sure you're documenting. As it relates to Airbnbs, currently the guidance says that Airbnbs are considered short-term rentals because you have people coming in and out. They're not staying there for a long time. Short-term rentals is usually, if the average time that someone's staying in there is less than a week, then it's going to be considered short-term rentals. So in the IRS's eyes, Airbnbs are generally considered passive.
Okay.
But there is an opportunity to be able to classify it as active, but you have to demonstrate and show that you're providing substantial services. Substantial services mean that you're pretty much treating it like a bed and breakfast. Are you going back in there and cleaning the rooms every day? Are you treating it like a hotel? Are you providing breakfast for them? Are you pretty much providing concierge, like a whole bunch of other services? If you're doing that, then they may look at it as active income. And if it's active, remember that you can also be able to have it or make what's called the S Corp election by filling out a form called 2553 during the year. The timely due date on that is in March, so you want to make sure you do it by March 15th. But anyways, to answer your question, generally speaking, that's going to be passive, short-term rentals.
Do you recommend for people to pay quarterly or yearly on their taxes?
Yeah, so what the guidance says is if you make more than $1,000 in profit, you need to be making estimated payments on your taxes.
Correct.
So the estimated payments, those happen on a quarterly basis. So yeah, you want to make sure you're paying your taxes on a quarterly basis if you're going to make more than $1,000 in profit in your business. So yeah, the what happens is if you pay it once a year or pay it at the end of the year, then this is when you can get hit with what's called an underpayment penalty. So they actually give you a penalty for not paying the taxes during the year because they want their money. I
gotta talk to my guy. I'm paying penalties, huh?
You possibly. So one of the ways to not have to, one of the ways to reduce your risk of paying the underpayment penalties is what's called a safe harbor rule, meaning that if you are about paying what you paid last year, a little bit over than that, like 110% of what you paid last year, during the year, then you're good.
Got you.
So that they kind of give you some grace there. It's like, okay, well, at least you gave us what you gave us. At least you were paying what you paid us last
He
year.
has said that to me.
So
he was like, my number's been pretty even the last few years.
Yes, you good.
So he was just like, we're good. But he said that, but I was just double checking with you, bro.
Yeah. So one misconception is LLCs, right? So we talked about LLCs. With an LLC, it doesn't inherently have any tax implications. People freak out when I say this. Just because you have an LLC doesn't mean you're able to write things off. Essentially, right? You can, but that's not what the LLC is designed to do. The LLC is a legal entity, and you register that with the state. That's why, for tax purposes, LLCs are considered disregarded entities, because we're just the IRS is like, what are these? It doesn't. We don't care whether you're LLC, whatever the case is. What we care about are the tax entities. So you can be taxed as a sole proprietorship, partnership, S corp, or C corp. Right? That's your tax entities. So the LLC, one of the benefits of it is you can decide how you're going to be taxed, but the LLC doesn't necessarily provide you any extra tax benefits. It just provides you legal benefits, right? So I think that's one huge misconception that people don't get. It's very technical, it's very nuanced, but I always like to make that distinction, because a lot of people just say, hey, get an LLC right off your lifestyle. And it's like,
I understand. I've been told before that I could pay my child a certain amount to kind of use that as a deduction and to reduce my tax liability.
Right.
All right. Can you talk about that?
Yeah. That's another big one. So basically, one of the benefits of being a business owner is that you're able to pay your children through the business, right? So the way that works is this: if you have children, right, dependents that are under the age of 18, which means 17 years and younger, then you're able to pay them through the business. And you're able to pay them through the business, like you said, take a tax deduction for the business, and then you and the child do not have to pay taxes on that income that you're paying them. But there's rules with that too. So basically, some of the rules that you need to understand in order to be able to do this properly is, one, it needs to be under the standard deduction amount, right? So the standard deduction amount for 2021 is $12,550. So if you're paying them less than $12,550, you're good on that mark. The next thing is they need to be providing legitimate services for your business, right? So legitimate services for maybe your real estate business is maybe helping you clean the unit, maybe promoting it on social media. Kids are really good with social media, so maybe having them do that, video editing, whatever the case is. They need to provide legitimate services for your business. You should have a job description for them, and make sure you're documenting their hours as well too, right? And you want to make sure you're paying them a reasonable amount too, right? So sometimes people try to push it and say like, yo, I'm about to pay my kid $100 an hour to clean my office, right? That's when you're pushing it, right? So you want to make sure you're looking at what the market would pay for that particular service. So you want to make sure you're paying them the market rate. Another thing that you want to make sure you're doing is that they have their own separate account. So the money needs to go from your business account into their account. So they need to have a completely separate account from you and the business. Also, too, another thing that you want to consider is the IRS does not specifically have an age minimum in order to do this, but I tend to tell my clients that you want to consider doing this when the child is 7 years old and older. So between the ages of 7 and 17 is a safe range for me. The reason why I say 7 is because because there's a court case. So basically there's a court case that whether it's some parents paying their children and the IRS passed that. So they won the case or whatever the case is. So because we're looking at, that's another thing with the tax law too, is like the IRS does leave it very open for your interpretation. But then the court cases pretty much set the precedent, basically share like, okay, this is how it actually works in real life. So 7 years is a safer age to do it. Some people push it and do younger than that, calling their kids models or whatever the case is. People do it, but I'm saying 17 is a good age. And then also too, with that, you want to make sure that with the with the child that you're just making sure that you're documenting it, and basically not calling it payroll. You can call it. There's different ways you can do it, but one of the ways you can do it is call it outside service labor. So they're providing that service. One of the nuances, though, I do want to share is that if you're an S corporation, it's not there's a little bit more of structure that's involved in order to do that. So you can't pay them directly through S corp. But if you're LLC sole proprietorship, that's a lot easier. Yeah, the biggest thing I want you guys to take away is taking this tax thing seriously, making sure that you're working with a professional that's going to help you proactively save money on taxes. Really, when it comes to taxes, there's several taxes that we talked about, right? You got income tax, sales tax, capital gains tax, property tax, estate tax, right? But the biggest tax of them all is ignorance tax. And that's the tax that you pay by not knowing how to proactively save money on taxes, right? You end up overpaying in taxes. You could lose your business. You get fines and penalties. So just taking this information seriously, applying it, you know what I mean? I dropped a lot of gems, some real practical things that you could do today. Also make sure you tap in working with that professional that's going to help you get on point, because really, at the end of the day, it's not how much you earn, it's how much you keep. And if you have nothing to keep, you have nothing to pass down. So that's all I got to say. That's it. That's all.